Good day, everyone. My name is Michael Florentiades. I'm the Chief Economist here at xm.com, and this is your European Open briefing for Thursday, 30th of March 2017. The key points you should know about today: the euro drops on a Reuters report that the ECB did not intend to signal the possibility of the end of stimulus or the end of low rates following its meeting earlier in March. The dollar gained across the board as other measures faltered. We already talked about the euro. The yen also challenged a little bit by positive risk appetite. Sterling was closely watched, but the trigger of Article 50 yielded little fresh insights, and I believe there was less volatility than expected. In today's economic calendar, we will have Eurozone economic sentiment, German preliminary inflation, final GDP growth, economic growth from the US, and we are also getting some Fed speakers, New York Fed's Bill Dudley and Robert Kaplan. Now, according to Reuters, the ECB did not want to signal that it is thinking about a change in policy. Many are speculating that because inflation is rising in the Eurozone, the ECB is going to be forced to change its approach and QE, push rates higher. However, the message from the ECB is that easy policy is here to stay, and the rise in bond yields could be problematic to some heavily indebted southern countries such as Portugal, Italy, and Spain. So the ECB wants to prevent that. Brexit also could be an issue for the Eurozone, for the ECB. So this is keeping the euro contained. Now, what happened to euro dollar after poking its head above 109 on Monday, just making a 4.5-month high just above 109. The euro now is quickly down to 107.50. I think the message from the market is that the 105 to 109 range that has been in place since the beginning of the year is still in place. Plus, we have to keep in mind that this area, especially just above the 108 to 109 area, contains the 200-day, and the 106 to 107 contains the 50-day moving averages. So it's a congested area. The dollar index, we have seen it rising and floating up to the 100 level because of the gains versus the euro and some gains versus the yen, hovering around 111 dollar yen. Now, expecting the Fed to raise interest rates another couple of times this year, there is also some optimism that the Trump tax agenda is going to move forward this year. So dollar bulls are not giving up. In terms of data, today we have the final fourth quarter GDP. This is expected to be revised slightly higher, and there is good optimism that the first quarter will see decent growth, as opposed to the weakness displayed during the first quarter of previous years. On to sterling and dollar sterling, we had the trigger of Article 50 by the UK. This starts a 2-year process of exiting the EU, 2-year negotiation process, I would say. I would say overall the message of the day was mixed. May's letter, Theresa May, the Prime Minister of the UK, had a constructive tone, but also contained some threats on security, or maybe withdrawing security cooperation with the European Union, and what would happen if there is no deal. The EU also struck a positive tone with its President Donald Tusk, but seems to refuse to discuss the terms of the new relationship before the divorce details are finalized. And I would just comment that sterling was relatively quiet for such a quote-unquote historic day, the Article 50 trigger. On to oil, it had a big jump yesterday. We had a smaller than expected build in US inventories, 0.86 million versus 1.35 expected. We also had smaller draws in distillates gasoline. So across the board, I mean, the beat in crude inventories is fairly small, but if we take into account distillates and gasoline, then it becomes something a bit more significant. There was a bid in the oil market because of some disruptions in Libyan output these days, so this helped WTI oil push towards the $50 a barrel level, but it has stayed below $50, we have to point out. In currencies, this was a little helpful for the troubled Canadian dollar. This has pushed USD to CAD down to 1.333. Finally, we end with the economic calendar. As we said, we have the Eurozone economic sentiment, but also industrial sentiment, services sentiment, business climate, consumer confidence. So a lot of indications. This is something that the market does watch. It can have some useful insight. Later in the day, we will get the preliminary German inflation. This comes out just before tomorrow's flash Eurozone inflation. This is for the month of March. Later on, we will have the final GDP figures for the US together with the initial jobless claims. And later in the day, we will have Fed President Studley and Kaplan are scheduled to speak. But I don't think we're expecting anything different than the message that has been repeated these few days, the 2 hikes for the remainder of the year. Thank you very much for watching and have a great day.